The US economy is at a crossroads, and the warning signs are growing harder to ignore. Some of the top economists in the country are signaling that a recession might be closer than many Americans realize. While headlines often focus on stock market highs or employment numbers, the underlying economic currents suggest a different story, a story of slowing growth, rising costs, and potential financial turbulence that could touch every household. Understanding these signals now could mean the difference between being prepared and being caught off guard. Let's start with growth. The US GDP has been slowing after the rapid recovery following the pandemic. Although unemployment remains low on paper, the quality of jobs and real wage growth tell a more complicated story. Inflation has eaten into the purchasing power of many Americans, and wage increases when adjusted for rising prices are barely keeping up. This combination of slow growth and persistent inflation is a classic warning sign that economists watch closely before a recession hits. Interest rates are another major factor. The Federal Reserve has been raising rates to tame inflation, but higher interest rates impact everyone. Mortgages, auto loans, and credit cards become more expensive, leaving households with less money to spend. Consumer spending makes up nearly 70% of the US economy, so when Americans tighten their belts, the effects ripple across businesses and local economies. Even strong companies can feel the pinch when consumers pull back. One particularly important indicator is the yield curve, which compares short-term and long-term Treasury yields. Recently, the curve has inverted, a situation where short-term rates are higher than long-term rates. Historically, an inverted yield curve has been one of the most reliable predictors of a recession, often signaling economic trouble 12 to 18 months ahead. While it's not a guarantee, it is a signal that top investors and economists take seriously. The housing market also tells a critical part of this story. Home prices, which surged during the pandemic, are beginning to slow or even decline in some regions. Higher mortgage rates have cooled demand, and affordability challenges are making it harder for new buyers to enter the market. When housing slows, it doesn't just affect buyers and sellers. It affects construction, home improvement, real estate services, and even local government revenues. The chain reaction can be significant. Corporate earnings are another area of concern. Many US companies remain profitable, but rising labor costs, supply chain issues, and interest expenses are shrinking profit margins. In uncertain times, businesses often respond by cutting costs, which can include freezing hiring or laying off workers. These decisions then impact consumer confidence, creating a feedback loop that can accelerate an economic slowdown. Global factors add further complexity. Trade tensions, geopolitical instability, and supply chain disruptions are not confined to foreign markets. They influence the US economy directly. For example, energy price spikes or banking instability overseas can have immediate consequences for American consumers and investors. This interconnectedness means that even domestic policies cannot fully insulate the economy from global shocks. So, what can Americans do to prepare? Top economists suggest taking proactive steps rather than reacting when trouble arrives. This could mean paying down high-interest debt, building an emergency fund, and reviewing investment portfolios with a focus on resilience rather than short-term gains. Diversifying assets and considering sectors that historically weather recessions better, like consumer staples, utilities, and certain dividend stocks, can provide a buffer during challenging times. Financial literacy and preparation are more valuable than ever. It's also important to recognize that recessions, while challenging, are a natural part of economic cycles. They often reset imbalances, create opportunities, and prepare the ground for future growth. The key is awareness and planning. By staying informed and taking steps now, households and investors can position themselves to navigate a downturn successfully, rather than being overwhelmed by it. In the coming months, watch for signals like inflation reports, unemployment data, Fed announcements, and corporate earnings. These will provide insight into whether a recession is truly imminent or if the economy can maintain its balance. While we cannot predict the future with certainty, taking a proactive approach, strengthening finances, understanding risks, and making informed investment decisions can make a significant difference. The question isn't just whether a recession will occur, it's whether you're ready for it. In a world of economic uncertainty, readiness can be your most powerful advantage, turning potential challenges into opportunities. Staying informed, planning strategically, and